Good afternoon. This is Arlan Suderman, Chief Commodities Economist with INTL FCStone, and welcome to what we hope will be many webinars as we take a look at USDA's crop report that came out today, kind of break down some of the highlights. We won't spend a great deal of time on it. We want to keep it moving and then have time for question and answers at the end. We're glad that you could join us today for this analysis. We'll take a look at some of the highlights of what USDA did in this report. They made some curious moves. All could be justified, not to debate them, but a little bit unusual as far as tendencies of USDA goes. And that's something I spend a great deal of time looking at, is the tendencies of USDA. So we'll take a look at that and what the implications are, and then we'll take a look at where do we go from here, and what will be the focus of the market going forward. And like I said, give it time for some question and answers. You should be able to submit your questions there on the screen, and then at the end, we'll go ahead and take a look at those questions and answer them. So as we go forward, I want to put this in perspective, first of all, the markets, and within what context are they looking at this data from USDA. Price is still a function of supply and demand in today's markets, but as modified by the flow of money. And so that flow of money has been having a big impact on our markets, will continue to do so. What you see on the screen here is a weekly CRB index, the Thomson Reuters CRB index charts. And you can see how we confirmed a bottom or put a bottom on the charts here this winter and into the spring, largely following the pattern that we saw in crude oil being the leader. Many of the major commodity indices have done so. We've had better than a 20% retracement now of the long-term decline off the 2011 highs. That has encouraged a lot of money flow into the broader commodities, and including the ag sector. That changes the filter through which the funds look at supply and demand fundamentals. For example, at the time when we were in decline and money flowing out of the commodities, we would see the fundamentals, or the funds would interpret the fundamentals in today's report in a much different way. So we try to look at how the funds interpret the data that's come out in light of money coming into the broader commodities. Now I show you the CRB chart. To put in context, this next chart, which here again we see the orange line being an indication of the CRB index and its value, but the shaded area showing net fund investment in corn, soybeans, and wheat. You can see back in early September of 2012, the net fund ownership of corn, soybean, Chicago wheat, and Kansas City wheat topped $68 billion. Earlier this year, it dropped down to essentially zero, just above zero, and that's a combination of large negative position held by the hedge funds and this constant, fairly constant anyway, positive position held by the index funds. And they correlate pretty well. We see a correlation there on the chart of 0.73, and we generally see a correlation of 1-to-1 would be essentially perfect correlation. As A goes up a certain amount, B goes up by the same amount. A correlation of 0.73 is generally considered to be fairly strong. And so there is a correlation there, and that's why I mentioned the funds, the index funds. When they want to buy the commodities, they buy one of these indices. They can buy the individual commodities as well if they have a particular story, but it does have an impact then on money coming into the grain and oilseed markets. You can see here on this chart what we've seen just in the last 3 months in growth of the commodities. Soy meal leading the way, roughly 50% gains. Soybeans shortly behind that. Soybeans have not been going up as fast as soy meal. I'll leave it up to you to decide whether soybeans are undervalued relative to soy meal or soy meal overvalued relative to soybeans. At some point, we would anticipate that relationship will correct itself, but it could be a wild ride in between with some significant risk there. And much of this is in corn's trying to follow behind, wheat well behind, as you see on the chart. And really, as we go forward, that's because soybeans and soybean meal have the best opportunity to see a tight balance sheet develop over the coming months if, in fact, the weather patterns continue on the pace they're currently on. Now, first setting the stage, we had the crop problems in Argentina, where persistent rains, just as the crop matured, hurt production and hurt quality. and that has sent business to the United States. That's tightened up the global balance sheet somewhat, narrowed the safety net. Now, if we have a normal crop this year and everything moves forward, then we have no reason to maintain prices at these levels. But we have narrowed the margin for error, and this is a transition year from El Nino to La Nina. The funds don't trade what's currently happening, they trade what they anticipate happening, and they've looked at the weather forecasts and they anticipate a risk of this transition from El Nino to La Nina, creating problems in the Midwest, warmer, drier conditions before the end of the growing season. Soybeans are most vulnerable because of the strong demand base. Corn also can be hurt, but it's most vulnerable in July. And if the transition doesn't take place until August, then the effect on corn yield wouldn't be as great as would have been soybeans that are most vulnerable in the month of August when pod set and pod fill. Also, with corn, you have the substitutionary effect of wheat. We'll talk a little bit more about that. The higher corn prices go, the more it helps pull volumes of wheat into the feed stream, both domestically and globally. And that's something wheat really needs to do because of the huge surplus, which USDA confirmed in this morning's crop report. So that's why the money's been chasing after the soybean market. And we'll talk about some of the possibilities going forward as we go deeper into the presentation today. I see today's report, the pivotal numbers being the South American production numbers again, because they set the stage now for the 2016 growing season here in the United States. USDA didn't change its corn or soybean production estimates for Argentina. We're still expecting, based on the input we get from our team down in Argentina, that we will see a modest reduction yet, the 25 million metric tons for the corn crop, 56 million metric tons for soybeans, tightening up the balance sheet just a little bit more. For Brazil, USDA moved much closer to the estimates released by our Brazilian team. Our Brazilian team's estimates have been among the lowest in the industry. CONAB came down toward those estimates, in some cases a little below those estimates, and the private industry is now starting to go below. But I have to give credit to our INTL FCStone team in Brazil. They were reducing their estimates down here while the rest of the industry was going up and above 100 million metric tons for the soybean crop, above 81, 82 million metric tons for the corn crop. So our team down there has done an outstanding job, and we appreciate that. But this really sets the table then for the U.S. balance sheet. Now, looking at the old crop stocks, and I want to say, well, we have the trade estimates there, our INTL FCStone estimates. While I did submit estimates and they're widely published, I made some additional revisions this week based on some of the latest data that didn't show up in the published estimates, and you see our latest estimates there on the tables. For old crop, USDA coming down on corn to 1.708. We still see things ending up a little bit tighter there yet before we finish up, but quite ample yet. Not a problem on old crop stocks. Same thing with soybeans. USDA came down to 370 million bushels, kind of where I thought that they would for this report, while our final number is closer to 343 million bushels. Those ending stocks estimates then become beginning stocks for the new crop marketing year that starts September 1. So you see what USDA did there versus the trade estimates in the lower right-hand corner of the slide. USDA on wheat going to 1.05 billion bushels, still not near where we are. I think USDA will raise their production estimate further. Big crops get bigger. To go to the extent that they did today in the report means that, based on history, that increases the risk of going higher in the July report, and we reflect that. I also think USDA is a little overly optimistic on both their feed estimate and their export estimate. The feed, it would seem to make sense. It seemed logical that we would feed 200 million bushels or more of wheat in this type of scenario. But thus far, we're just simply not seeing the feedlots and the plains really, and that's where we can feed the bulk of our wheat to have the biggest impact on feed usage. They're just not showing the interest because there's so much shall we say it, cheap corn and grain sorghum in the region that's available to them, particularly with the wheat being lower protein this year. Right now, we're looking at averaging maybe 11.5% protein. Kind of when we look at it, we're seeing a range of below 8% as an extreme and some above 12%, but still disappointing protein, and that makes it even tougher for the wheat to make its way into the feed stream. So I think USDA is a little more optimistic. Let's talk about the corn. USDA essentially coming down to 2 billion bushels on its ending stocks estimate. Here again, I think they're a little bit optimistic on their export target and on the feed usage target. You say, well, Arlan, your ending stocks number is lower than them. That's largely because I have a lower yield estimate. I use a 30-year yield, and then I adjusted that for where the acreage are. We had the expansion this year in the plains and in the south, both of which are more vulnerable to yield reducing factors typically, and I think particularly this year. And so I pulled my 30-year trend yield is 167, below USDA's 168, and I took a bushel off of that, which statistically kind of fits well with where the expansion is when you look at it by the states. And so it leaves me with ending stocks and new crop of 1.763. That's plenty adequate if we get that, but that's the big question. Will we drop that off? And I'll put that to a little bit more of a sensitivity analysis a little later in our presentation. So we look at soybeans, USDA down on new crop stocks, down to 260 million bushels. I'm down at 235 roughly. And the big differences there, of course, USDA and this kind of scares me to some extent, to be honest. USDA's demand estimates match my demand estimates. Why does that scare you, Arlan? Well, because USDA has a track record of underestimating soybean demand, new crop soybean demand at this time of year. And I'll show you a graphic on that here in a little bit, but it's a strong tendency. So for their demand estimate to match mine at this time of year when I'm usually well above USDA, kind of scares me. Does that mean they've learned from the past and that they're really figuring out this demand situation from China? Or is demand even that much stronger? So that's something we'll take a look at and go forward. Let's break it down a little bit more. Here's what I was talking about on USDA tendencies. When you look at corn, USDA's new crop estimates this time of year, pretty much sometimes they're too high, sometimes they're too low, depending on which category you're looking at, be it production, be it exports, feed usage, but it pretty well splits down the middle. Half the time they're above, half the time below, and that suggests they're doing pretty well. On soybeans, they're consistently good at underestimating demand, and that generally results in them overestimating ending stocks. In fact, their June final soybean ending stocks estimate has proven to be too high in 17 out of the last 20 years. And if you look at one of those 3 years that they were not too high, it was just by 1 bushel. So essentially, they have a strong track record of being too high with ending stocks, that most years, final ending stocks come in below, on the average of those 17 years, of 127 million bushels. So you take off 127 million bushels off of USDA's 260 million bushel final stocks estimate, and all of a sudden, you're very tight with soybean supplies. And so that's why I say USDA's tendency at this time of year is to overestimate stocks because they underestimate demand. And so when my demand estimate matches theirs, that gives me pause to wonder. Now, when we look at corn stocks overall, this is global corn stocks in the top graphic in terms of days of use, 74 days of use. And that's really, I think, the best way to look at ending stocks is in terms of use or percentage of annual usage. Because if you tell me you sell widgets and you're going to have 100 widgets left over at the end of the year, that doesn't tell me anything unless I know how many you sell in a year. If you only sell 50 in a year's time, that means you have a 2-year supply. And I really don't think that looks very good on as far as a business model, and you got a 2-year supply in your inventory, that suggests prices going lower. On the other hand, if you sell 1 million widgets per year and you only have 100 left over at the end of the year, that means supplies are pretty tight. And that means prices probably need to go up to ration that demand or to stimulate you to do more production. So I look at corn stocks, global corn stocks in terms of days of supply. This is USDA's projection of a 74-day supply. Now you look a few years ago, we were 19 days smaller at a 55-day supply when we set the record high prices. So it's basically a just-in-time supply. The market's very comfortable with that unless supply is legitimately threatened. And that's the big question mark this year. If it were not for soybeans, we probably wouldn't have the premium that we have in corn today. So soybeans are helping pull corn higher. The breaks, though, come from the wheat. In the bottom chart, since wheat is so interchangeable with corn and the feed rations around the world, particularly overseas, more so than here in the United States, I combine them in the second chart. You can see we have almost a 100-day supply when you put surplus wheat and surplus corn together. So a little bit more comfortable, and that's the problem that corn has. If it were not for that big wheat supply, corn prices would be following soybeans a little closer on this rally. Because of that big wheat supply is one reason that they have a problem. Now, let's talk about the possibilities. As I look at this, and here again you see on the left-hand side of the chart my 166 bushel yield, and I have 1 million fewer corn acres than USDA. And that's going to be one of the big question marks on June 30th, is just what is the acreage? The rapid planting pace that we had and the favorable weather overall, even though it was delayed in the east, would suggest more corn acres than USDA. But with the rally, we saw big interest in soybeans. Yes, corn prices went up. Soybean prices went up even more. And we had some areas in the south where they're worried about heat sooner in the year that simply couldn't get planted when they'd like to have gotten planted. And there's some other areas, not core areas so much as fringe areas of the Midwest that had problems as well. And I think it'll add up to almost a 1 million acre reduction in corn acres. But there again, that's where the big volatility could come, or the big surprises could come on June 30th. So I look at some possibilities here. And on the scenario on the left, I use that 166 bushel yield with 1 million fewer corn acres, and I have ending stocks of 1.763 billion. And you see we end up with a marketing year average price around, and that's a cash price, putting it into regression around 360 per bushel. Now let's say that we actually increase corn acres by 500,000 acres, and we get a 172 bushel yield, and demand isn't quite as good as what USDA thinks. All of a sudden we could be looking at nearly a 2.8 billion bushel carryout, which would give us ending a marketing year average price of a little over $3. That risk is still there. Not likely, but it has to be respected as we look at this rally. That risk has to be respected, that we build stocks at that level. That would be quite a challenge for the industry to find storage, particularly with the large wheat crop we already know that we have. On the other hand, if we lose that 1 million acres of corn, I don't think we'll lose more than that. And we see the yield drop to 158.3 bushels per acre, which we've seen a yield like that just a few years ago. So it's very possible. All of a sudden we see stocks dropping down to that 1.1, 1.2 billion area, and we see prices take off, particularly because that type of stress would also be favorable for tightening soybean stocks. And we are currently in an environment where money flow into the broader commodities. And so that leaves us an upside risk in marketing year average cash prices here above $5. That's kind of the borderlines, the parameters that we would see as most likely. Can't rule out something outside of that range. That kind of puts a parameter on the possibilities here, again, with the more likely scenario being on the left-hand side. Let's see what this looks like now as we move forward to soybeans. Well, first of all, I want to say on the left-hand side of that scenario, I actually add 2 million acres to USDA's number. First of all, higher soybean prices, from all the evidence we look at, are adding soybeans in core production areas, but also double crop. And I'm making some assumptions here based on what we're hearing about seed sales in the double crop areas, southern Midwest and the plains, and looking at the forecasts, look like they're going to be fairly favorable for double crop soybean planting. And I've added 2 million acres, as you see here, as I told you, and I could see adding another 400,000 or so. Here again, this could be one of the big surprise areas on June 30th when USDA announces the results of its producer survey focused on June 1st. But with the demand there, and one other caveat I need to say is USDA is at a 46.7 bushel yield. I'm at a 45.5 bushel yield. First of all, a trend, 30-year trend yield for me would be at 46 bushel, not 46.7 USDA has. Excuse me. So 45.5 bushel yield, but with 2 million more acres. Our demand estimates match USDA. That leaves me with 235 million bushel ending stocks. Now, what if we actually drop USDA's yield, not my yield, the higher USDA yield? We have a warm, dry August, which forecasters are more and more comfortable with, confident in, and we take 5% off the national crop. That heat would be most focused in areas where we'd have a lot of those double crop acres. Going in late, shorter growing season would also impact their yield as well. So that would be about a 44.3, 44.4 bushel yield nationally. That would drop ending stocks below 4% of stocks to use ratio, which is generally considered to be a tight pipeline supply and could get explosive on prices. You see that in the right-hand scenario here. Stocks would be even tighter, but with those higher prices, we would start rationing demand. The bearish scenario in the middle, and these again, cash prices, the bearish scenario, I said, okay, we increase the acreage, but La Nina never gets started during the growing season, and we have a good growing season. We end up with a 47 bushel yield. A little bit of warmth at the end, so we don't get the 48 bushel that we've had in the past, but a 47 bushel yield. And we quickly take stocks to burdensome levels. That too must be respected. Now, I talked about the demand side of things. Here's a graphic showing Chinese demand in the blue bars, the yellow bars showing imports into China, both from South America and the United States. And you can see the exponential rise that we're seeing in demand in the China. And as you look at that trend line there, that's why I have on my global balance sheet Chinese demand of 103 million metric tons. And I have a higher import number then as well, but I also expect Brazil to be able to successfully meet more of that demand than what USDA is currently saying, although we will, I think, have higher crush than what USDA is currently projected. I think we'll get more of that crush business from Argentina due to some of their quality issues. But you can see the solidness. The only times we come below there are 2003 and then in 2008 when we had the recessionary conditions in China. Now, looking at the wheat, excuse me. See if I can hold my voice through this. Look at where the gains are in the wheat yields. We saw a record winter wheat yield, 50.5 bushels per acre. That gave us a national all classes wheat yield of 48.6. I came into this report looking for 48.3. Looking back at the numbers since the report came out, now I've pushed it up to 49.1 bushels per acre. And a lot of that's going to depend also on what the spring wheat crop does. We could see some dryness there. So far, things are pretty good. One of the real issues, and I want to thank Yui Yang on our staff for putting together this chart, looking at protein content. And as we've been working with Mike O'Day and looking at protein in years with higher rainfall, we took a look at the pattern here, and you can see the tendency that the more rainfall you have January to May, Kansas protein levels tend to drop. You can see the red dot there is where precipitation was this year for Kansas for that January to May period, suggesting protein levels in what, the 11.8, 11.9% area. There's a fairly wide standard deviation there on this, it looks like, so we could drop down lower. As I said, so far we're looking at averages coming in 11.5, but generally lower protein than what we'd like to see. Now, as we look, the top left graphic shows, as we look back at the last 20 years or so, The bars are U.S. wheat stocks in terms of days of supply versus the line is the marketing year average cash price. And you see the correlation there being minus 0.17. Pretty weak correlation. And we've long said U.S. wheat prices seem to correlate more to headlines, and those headlines tend to be made by what's driving European stocks. And so on the lower right-hand side, we see the same graphic, but with European stocks of wheat, and we see a stronger correlation just below that key 0.7 level. So pretty good correlation between U.S. cash prices. That's good in this case because European stocks, while large, their demand looks pretty good now this year as well. They do have some quality issues that could come if we continue wet. That could change things. So based on current demand projections, we're looking at stocks not being as big as what they are here in the United States in terms of days of supply. So that does give the opportunity for prices to recover once we've been able to price some wheat on the cash market into the feed stream. Now, where do we go from here weather-wise? So we work with our partners over at Commodity Weather Group. These are the key areas of ocean sea surface temperatures that are being looked at. And you see there the Ensotropical Pacific. That's where we see the region, particularly 3.4 region, where we measure sea surface temperature anomalies with El Nino being warm, as you see on the graphic here. But if you look very closely, you see a very thin line in the middle that's cooling off, and that says we're moving toward neutral, toward a La Nina pattern, which would be a cooling of those waters relative to normal. But also the Indian Ocean. When the Indian Ocean is above normal as it is now, that tends to give us wetter summers in the Midwest, more mild, wetter summers. The cool pool of water there between Alaska and Hawaii, but yet warm next to the West Coast. That combination tends to, once again, give us wetter summers because high pressure sets up over the West Coast. Storm track goes up over the top into Canada and down, and we get the rainfall in the Midwest at least through June and July. So those are some of the key areas that we're watching to come up with the outlook. Basically, this pattern is expected to break down and go more toward La Nina impacting things with the sea surface temperatures in the Indian Ocean and off the West Coast starting to moderate as we get later in the summer, like the end of July and August. Here's the latest outlook. At the top, we see the 16 to 30-day outlook. Warming up, southeastern half of the Corn Belt, looking at risk of drier conditions. That's a concern past this next week's rain event. That makes this next week's rain event far more pivotal in the eyes of fund managers who have a lot invested in this market, as well as producers and end users. So we look at the outlook for the month of July. Currently, the areas at risk look more to be the northwestern Midwest, but heat really not much of a problem. Now, the northwestern Midwest is expected to get some good showers in the last part of this month to help tide them over. So that heat will be critical, how much it is there, what the scope of it is, as to whether that moisture is sufficient. But when we look at to August, you see in that bottom graphic, that's when the heat is really expected to move in, and the northwestern, shall we say 2/3 of the Midwest, really dries out. And that could be a real concern for soybeans and for kernel size on the corn. So after pollination, but when we're determining kernel size on corn. June 30th is a big report now. That is when we find out the quarterly stocks, known for its surprises by USDA. That's also when we get the acreage numbers from the June survey, first survey. You see there this graphic from Matt Zeller on our team, the lines there being limit up or limit down moves for corn and soybeans, and the price reactions to that June 30th report in years past. It can be a very volatile report. I would say probably the second most volatile report we have all year long. Excuse me. So if you have questions, get ready to do your questions. Take home points. The focus now shifts to USDA's June 30th acreage report, as I said. There's a great deal of uncertainty over the acreage and the stocks. We'll have a lot of debate about acreage. Look for soybean acreage to go up a couple million. But in the end, It's still about yield, and that means weather. See if I can hang on here a little bit longer, folks. Soybeans are the most susceptible to the tight balance sheet, followed by corn. Wheat is burdensome. Finally, cash wheat is the anchor to this market. We have lots of wheat that needs to work its way in the feed stream. In Brazil, we're doing that. They don't have anything else. In fact, they're moving into milling quality wheat now to keep the livestock fed. And in Europe, we're doing that. We're just not seeing it to the extent we need to in the United States yet. And legitimately or not, next week's rain event is pivotal. The models are pretty confident right now that we're going to get a good rain event over at least 75% of the Midwest. But coming back, this is really going to be our first weather weekend in the markets because it will really pay attention to what happens, particularly if the extended forecast, that 16 to 30 day, leaves the southeastern half vulnerable. So that wraps up our presentation. We could have gone in a lot more detail, but I wanted to keep it close to 30 minutes of comments and then have some time for question and answers. So I invite you at this point to turn to a question and answer time and to put your questions up. Excuse me. First of all, we have a question come in on what clues are you looking for that might provide early indication of a switch to a warmer, drier weather pattern for the Midwest? And that would be the cooling of the sea surface temperatures off the West Coast and a deepening of cooling in the equatorial Pacific. I think those would be two keys that we're going to be looking at. Got a question here from David. May I have a copy of these slides? And I would say that we will have, I believe it's an hour from now, we'll have posted to the web. Well, you'll be able to see the presentation once again and see it. And of course, you can contact us at any time, and we'll see what we can do for a copy if you need something beyond that. The recording will be available, and we'll try to make the slides available if you contact us directly and through your contact person here at INTL FCStone, and we'll see what we can do to make that available to you. John has a question. Any thoughts on the size of prevented planting acres? This is always a big question mark about prevented planting, and of course, some of those prevented planted acres would be in the South as well as in the Plains. Kansas and Kentucky have been a couple of states really lagging into planting progress. Not near the problem we saw last year. Sound like I'm hedging my bets? Yeah, I am. Because I always have questions about USDA's acreage numbers, and I think many of us do have questions. The prevented planting is probably going to be somewhere in that 1 to 2 million acre, which is very typical. It seems like every year we're at least in that 1 to 2 million or 1 to 3 million acre range, and I think we'll be very close to that this year. And that's pretty much written into the numbers already, I believe. Jeff asked, did I miss your estimate of the June 30th corn acres? Right now, I'm looking for down 1 million acres from USDA. Now, I probably have less confidence in that than I do the soybean acres, because that's a bigger concern right now. A lot of unknowns with the rapid planting pace. The rising price levels should increase corn acres, but I think soybeans probably effectively took it away, particularly with some of the planting problems we had. Any comment on ethanol prices? Jeff also wanting to know through the year end. And frankly, it's going to come down to exports and whether we can keep the export market coming. In this presentation, I didn't prepare the material to really go into ethanol. I'm fairly optimistic that we're going to have steady ethanol demand. Ethanol prices tend to somewhat track corn. Is it a chicken or egg thing on doing so? But when we look at that ethanol demand, my number is actually slightly below USDA, but very close. Ryan asking, what impact on grain prices or commodity markets in general does the global collapse of bond values have? That's a money flow issue. And it really comes down to traders trying to see where can I put my money and where is it going to give me the best return. And right now what they're saying when looking at their options is the commodities. We've seen a nice rebound into bull territory, a better than 20% rebound in many of the major commodity indices. I think at this point, the money flow specifically in the commodity indices might redirect and hone in on specific commodities, specific assets that have more of a story. Will that be soybeans and soy meal beyond what we've currently seen? That depends a lot on what we see in the weather in the next few weeks. If so, then they could be favored. If not, then they drop. They're going to be looking, I think, more at selective assets within that class going forward. But that means they're looking for those places to put their money. Now we go to Tanner. Cash wheat in Southwest Kansas now cheaper than cash corn. Yes, we certainly have seen that. Are feedlots using this opportunity to switch? Very disappointing. We have not seen the degree of switch that wheat needs to see. Now, when it happens, that's negative for corn as well, but wheat really needs to see itself work its way into feedlots, and we're just not seeing the scope of it that we need to yet to this point. Susan asking, any comments on where the Canadian dollar futures are expected to go? Susan, if you'd like to contact me through your contact here at INTL FCStone, I'll be happy to go into more details on that. I simply didn't bring materials with me talking the Canadian dollar. I know that there's some questions about the GDP growth there in Canada and what the impact that'll be and what their central bank's going to do. I'm probably not prepared enough to talk about that at this point in this presentation. Jeff asking, with the gaps up in the CRB, could we be looking at commodity prices rising for 2 to 3 years? And yes, we certainly could be. I think the ags have a greater concern. The ags have opportunities now if we get weather straightened out and do not have prolonged weather problems. Then I think the ags have problems longer term because we see greater expansion in the Black Sea region and in Argentina and Brazil to once again supply us with plenty of supply. We can do that with the rest of the commodities going higher. A lot of it also depends on the global economy and whether we're able to get that ship going with better growth. That could be a problem longer term, but from a historical standpoint, these moves tend to be several years in length. Wes, and hello Wes. Wes and I go back a few years working together. Besides plentiful supplies of cheap corn and milo for the feed yards, keeping weed out, we're also hearing that the yards are well covered into September. Are you hearing what kind of coverage ethanol plants may have? Ethanol plants don't typically go that far of coverage. It's going to vary a lot from plant to plant, but they will generally not have as much coverage as what we see the feed yards do. John asks, any changes in world corn feeding number be lowered in future reports by wheat feeding around the world? USDA took some steps in that direction today. I think their steps are a little bit more aggressive than what we're seeing in reality. But I have to say, we're seeing more of the switch taking place outside the United States than what we are actually in the United States. Keith asking, will the world corn feeding number be lowered in future reports by wheat feeding? Basically the same question. And finally, what is your view? This is from Paul. What is your view on crude oil prices? Crude oil prices have reached the $50 mark and traded above the $50 mark. We've seen a pullback the last couple of days. That can be expected. We really haven't done any chart damage. Generally, we're in that area between 50 and 55 that the market has some real questions to answer. And that's because we anticipate, and we're starting to see it in rig counts, an expansion of rig counts above $50. This allows producers to hedge in some acceptable margins on production. We certainly see that interest from the financing side of things, pushing producers to hedge it in, and gives us the opportunity to increase. It takes time to increase. That's why I think it'll take time to pull those rig counts up and pull the production up. But it suggests we're probably, from a fundamental standpoint, should be near the high end of a trading range with a correction coming. But a lot of it depends on money flow and what we continue to see, whether we continue to see aggressiveness. My bias is we're very near that high end, maybe in that 50 to $55 range, and we correct lower and we find a sideways trading range here while we wait to see what the world economy goes. But I certainly wouldn't consider myself as experienced in the crude oil side as what I am in the grains. How valid, this is from Melinda, how valid are comments that the La Nina transition will impact the next South American planting and growing season? When you look at the connections or the correlations with the growing seasons, we have to be very careful, particularly with La Nina. The correlation isn't as strong for the United States. A lot of these other factors, sea surface temperature in other areas, play a significant role. It's just this year they're kind of coming together to give us an opportunity for impact. The correlation appears to be a little bit stronger for Argentina and southern Brazil. So the confidence is a little higher. There's still some issues of timing with their growing season. But generally, we would anticipate that if we go into a La Nina pattern, we would see warmer, drier conditions in Argentina and southern Brazil impacting yield. And that's one of the things that the funds are counting on as they build premium into soybean prices and soy meal prices. And generally, the more intense the La Nina event, the more intense the warmth and the dryness for that region. John asks, is or can the upside in soybean prices be impacted by the size of fund ownership? It can. Let's say that suddenly something happens to cause money flow to reverse out of commodities. Can soybeans still rally? Yes, they can. They're just doing so upstream. They're swimming upstream, so they have to work harder to do that. You have to have a little bit more compelling story fundamentally, but it can still happen. And we saw a good example of this a few years ago when just at the beginning of the bull market for cattle, when they rallied, when fund money was moving out of the commodities and the VIX was above 30. That's a pivotal level, by the way, for money flowing in. And they were still able to rally. So it can still happen. It just makes it more difficult to do. So if you have any more questions, be sure to get them in yet while we still have some time. We have another question here from Jeff. Should we count all the Chinese stocks as available to the world stocks days of supply? We did some analysis of this and correlation of looking at world stocks in terms of days of supply with and without China. We saw a little bit stronger correlation when you exclude China, but it was surprising that it wasn't stronger. So I'd say there is a little bit of influence, but it's really not what we would have anticipated it being. Is there anything particular you're looking for from the Federal Reserve next week to impact money flow? Yes, there is. Now, the statement out of the Fed on Wednesday will be the words will be parsed carefully. Janet Yellen, the chair of the Fed, when she steps in front of the microphone for a press conference, her comments will be parsed. But what I'm looking for is the dot plot. That's where each member of the board in that room writes down what they think interest rates will be, their key interest rate, short-term interest rate will be at the end of the year, at the end of next year, at the end of the following year. And all those data points are put on a graph. And that will tell us a great deal about what those voting members see as the aggressiveness of the Fed down the road on raising interest rates. That should influence the currency market and money flow into the stocks and into the commodities at large. And why are wheat prices trending higher if this year's crop is so big? That's a question that I've been getting quite a bit of. And to that, I'd point to the crude oil market. Crude oil put in a bottom, $26, $27 area this winter when things look the bleakest. That's typically when we put our bottoms in the market. That's where wheat is right now. Things look the bleakest. That's when the market is priced into factors. It's a futures market. Its job is to look ahead. And it feels like, while the cash market may continue to ration, the board starts turning the corner. We see the opposite happen at the tops. Tops are made generally when things look the most bullish. That's when prices start to collapse. And so as a result, that's why I think we're seeing a short covering in wheat and some bottom picking in there, even though the fundamentals look bearish. Now, of course, today's market took us back lower again. that could change those dynamics near term. We'll have to see how we confirm those bottoms as we go into next week. So any more questions you might have, this is your chance to get them in. Otherwise, I have one more question in. What impact do you see the large winter wheat crop having on the ability of corn to rally this summer? I really see it as being kind of holding corn back, kind of the drag on the corn market as it tries to go higher if in fact the weather does turn adverse. Soybeans have the easiest path higher if weather's adverse. The wheat will really be a drag on corn and make it more difficult. It can still do so, and it'll probably drag wheat higher with it. It just makes it more difficult. So with that, that concludes my presentation. I don't see any more questions coming up today. I thank you for being with us today, and as we said, the presentation will be available here over the coming hour, and we look forward to being back next month with another webinar following the USDA crop report at this same time. Thank you very much.